Welcome back to The Explainer. I am so thrilled you're here today because we are digging into one of the absolute biggest gold producers on the planet, Agnico Eagle Mines, ticker symbol AEM. Now, if you've been paying any attention to the financial news lately, the headlines for this company are practically glowing. But you know how we do things here. We don't just read the press releases, we actually look at the data. Today, we're setting up a bit of a central mystery. What if I told you there's a dark side to this mining giant story that the mainstream media is completely ignoring? We are going to peel back the layers, analyze the hidden signals, and even stress test this stock against the frameworks of history's greatest investors. Let's dive in. Here is our roadmap for today. We'll start with 1. Agnico by the numbers. Move into 2. 6 hidden red flags. Then we'll counter that with 3. Overlooked green flags. Tackle 4. The great moat debate. Apply 5. 3 legendary frameworks. And finally, wrap it all up with 6. The core contradiction. All right. Section 1, Agnico by the numbers, setting the baseline. To really grasp the mystery of Agnico Eagle, you first have to understand this massive juxtaposition that's happening right now. On one side, you've got this wall of bullish headlines. Record earnings, industry-leading costs, massive share buybacks. It sounds fantastic, right? But in the shadows, there are severe quantitative warnings and serious valuation risks building up. Our main goal today is to try and reconcile these two completely opposing realities. And to truly put the scale of what we're talking about into perspective, $74.6 billion. That is Agnico Eagle's current market cap. I mean, this isn't some speculative junior miner just hoping to strike it rich in the dirt. This is a highly established, massive global operation. Before we tear into their financials, we really have to respect the sheer gravitational pull of a company this unbelievably large. And, on the surface, this miner is firing on all cylinders. They were founded nearly 70 years ago, back in 1953, and they have operations in 4 incredibly stable countries: Canada, Australia, Finland, and Mexico. The valuation? It looks incredibly reasonable. A trailing PE of 12.6 and a forward PE of 11.6. Their revenue over the last 12 months is sitting at $14.5 billion, which is up over 50%. Net income is at an astonishing $5.87 billion, up almost 100%. Honestly, if you stop reading here, you'd think you just found the perfect stock. But let's look a little closer. Which brings us to Section 2, 6 hidden red flags, the twist. Okay, so here are the first 3 severe red flags flashing right under the hood. First up, Guru Focus flags that Agnico's assets are growing at 34% annually, but their revenue, it's only growing at 11.7%. Basically, they are becoming less efficient with every single dollar they invest. Second, multiple valuation metrics are sitting near 10-year highs. And guess what happens when valuations peak? Insiders cash out. Over just 3 months, we've seen 2 massive insider sell transactions, totaling 23,000 shares, with 0 insider buys. Nothing. Third, analysts are actually slashing their estimates. Full-year 2026 earnings estimates just dropped from $13.20 down to $12.09, and Zacks has even slapped them with a rank number 5, a strong sell. But wait, it doesn't stop there. Red flag number 4. Simply Wall Street ran a discounted cash flow model that calculates a fair intrinsic value of about $106 per share. With the stock trading much higher than that, the model implies it's nearly 60% overvalued. Combine that with red flag number 5, the Hope Bay mega project. They just approved a $2.4 billion investment up in Nunavut. That is massive capital expenditure, and it brings severe execution risk, cost overrun risk, and serious vulnerability if the broader market takes a turn. And then there's the absolute elephant in the room, the price of gold itself. We recently saw gold hit an all-time high of $5,589 an ounce. The entire bull thesis for Agnico relies heavily on that price staying high. But Morningstar's long-term normalized assumption for gold, it's just $2,050 per ounce. If gold reverts back to that normalized level, analysts are projecting Agnico's 5-year net income growth could drop by a brutal 13%. All right, let's flip the script for a second. Section 3, overlooked green flags, the counter twist. Agnico genuinely possesses a major competitive advantage in their all-in sustaining costs, or AISC. For 2026, Agnico is projecting their costs to be somewhere between $1,400 and $1,550 per ounce. The industry average? A whopping $1,800. That is a massive structural advantage. It essentially means that even if the gold price completely collapses, Agnico can just keep humming along, generating profits while their competitors are bleeding red ink. Then we have this incredible metric, 9 out of 9. That is Agnico's Piotrowski F-score from Guru Focus. Now, if you aren't familiar with this, it's a comprehensive 9-point measure of financial health. Achieving a perfect score is incredibly rare. It tells us point blank that their balance sheet, their profitability, and their operational efficiency are absolutely top tier. And the proof of that perfect score? It's their $2.9 billion in net cash with effectively zero net debt. Let me repeat that. In a highly capital-intensive industry where everyone is borrowing to build out mines, having a fortress-like balance sheet of this magnitude is something most mining executives can only dream of. So when management has that much cash on hand, what do they actually do with it? Well, they return it to shareholders. They have maintained dividend payments for 34 consecutive years. They just completed a massive $377.5 million share buyback, and they aren't just sitting back resting on their laurels. They're targeting 20% to 30% organic production growth over the next 5 to 10 years. Plus, they're doing all of this while operating entirely in stable rule of law jurisdictions, like Canada and Australia, meaning they completely avoid the severe political risks that plague so many other miners globally. Section 4, the Great Moat Debate, the interrogation. So we have a massive divergence among the experts right now. Morningstar looks at Agnico and definitively rates them as having no moat. None. Yet Guru Focus turns around and gives them a highly respectable moat score of 6 out of 10. When you see a massive disagreement like this between two highly respected research firms, that is a glaring signal in itself. It means we, as investors, need to pay very close attention and figure out who is actually right. The crucial thing here is understanding exactly why they disagree. Quantitatively, Agnico completely fails the moat test. Their 5-year average return on invested capital is a truly dismal 0.1%. But qualitatively, they're incredibly strong. They've got deep local ties, third-generation workers, and they operate in those super stable jurisdictions we just talked about. That kind of deep embedded community knowledge is almost impossible for a competitor to just come in and replicate. But here's the catch. Right now, their ROIC is sitting at a fantastic 17% to 18%, which makes it look like they have a moat. But that return is entirely driven by the recent massive spike in gold prices, not by some permanent structural business advantage. Let's bring in the heavy hitters. Section 5, 3 legendary frameworks, the experts. Applying different investing philosophies to this stock yields wildly different results. Take Benjamin Graham, the ultimate defensive value investor. He calculates a fair value of around $78 based on his incredibly strict metrics. At current prices, he'd call it severely overvalued. Then you have Peter Lynch, who loves looking at the PEG ratio. Because Agnico's earnings spiked 70% recently, Lynch's formula actually suggests it's undervalued by 60%. But let's be real here. Applying a hyper-growth tech metric to a gold miner simply because commodity prices spiked is a bit absurd. Finally, Warren Buffett's framework gives the company a 67 out of 100. That's a solid C grade. Sure, it has a great balance sheet, but Buffett docks them heavily for historical share dilution and a low baseline return on invested capital. Section 6, the core contradiction, the resolution. If you're taking notes, here is the entire explainer distilled down into one rare 4-way contradiction. The current financial metrics are undeniably spectacular, but the long-term sustainability of those metrics, highly questionable. As we just saw, expert valuation signals are violently conflicting, and ultimately it seems the stock market is just completely pricing in the assumption of permanent record-high gold prices. To me, this proves beyond a shadow of a doubt that your investment thesis simply cannot rely on flashy media headlines alone. Which really brings us to our final provocative question. What do you think gold prices will do over the next 5 to 10 years? Because at the end of the day, if you are buying Agnico Eagle mines at these peak valuation levels, you aren't just buying a great operator, you are placing a massive, concentrated bet on the answer to this exact question. If gold stays above $4,000, Agnico is an absolute premium powerhouse. But if it normalizes back down to $2,000, you are staring at some very significant downside risks. So do your own research, make sure you understand the assumptions built into the price, and as always, thank you so much for learning with us today on The Explainer.